So the most remarkable stat, guys, that I saw this last week is since the start of this bull market back in 2023, the Magnificent Seven now has accounted for literally 50% of the entire S&P 500's return. Man, oh man, talk about a few stocks doing a lot of heavy lifting. It's getting wild out there.
Yeah, it really is. But that's what happens when you have a market that's capitalization weighted. You've got a new hot fad going on right now. But the thing that's great about innovation, technology, and I think all of us look back in hindsight, the internet, going, well, duh, everybody became an internet company, everybody became a .com, everybody benefited. Why couldn't we see the forest for the trees back then? Same thing's going on right now, guys.
Yeah, and this reminds me of a stock from the '90s, Cisco. Cisco was like the Nvidia of today. Huge earnings, heavy valuation. That was the next great thing. I always ask myself, okay, well, when Nvidia goes away, what's the next great thing to come to the future?
I'll tell you what, I feel sorry for our competition because there are people who are putting their clients' entire portfolio in capitalization weighted investments, not realizing that they're betting the whole portfolio on three or four or seven stocks. I don't know how that meets a fiduciary standard, guys.
I think we're all kind of reeling still from the debate last week. And surprisingly, the markets didn't really do much since the debate happened last Thursday, and we're recording this today. But what's interesting is interest rates have really started to climb again. And I don't know, Bob, if that's because of the Trump tariffs that could potentially happen if Trump gets in, because it looks like his odds of winning right now have gone up a lot. Or it's because the price of energy is just going through the roof here over the course. So it's kind of been kind of this silent trade right now. Energy's up to $83 a barrel now, which is extremely inflationary. So I don't know. What do you make of it?
Here's what I make of it. Every debate, you tune into the campaigns of the candidates the next day. Of course, they won. Both sides won. You guys didn't know that. No, there's no losers. But here's the only thing I learned from the debate. If those two guys are single-digit handicaps, I still have a shot at the U.S. Open. Who are you kidding? How childish can you get? But I'll tell you, the market did react a little bit, right? During the course of the debate, the S&P futures went up 10 points and bond yields started to rise. And people try to extrapolate on, number one, what is the next administration? First of all, who's going to win? Nobody knows. Second thing is, what's the regime going to be able to pass? Nobody knows. And how's the market going to react to what they pass? Right. So, this is the problem people have with trying to project their beliefs, especially their political beliefs, onto what the market should and shouldn't do.
How do you think Ryan makes every single one of his investments decisions?
What? He doesn't have that coin I gave him?
Hey, I like to follow the trends. The trend is your friend, someone once told me. The problem is it's your friend till it's not. And
absolutely, yes.
Yeah, which, it also makes me think of diversification here. Because the one thing you've seen when the technology trade isn't working is the energy trade has done really, really well. In fact, if we look at our portfolios, our energy infrastructure pipeline index is actually the second best performer this year. And, oil, again, has kind of just been on the rise here, kind of quietly in the background. No one's really talking about it. But it's kind of like when some things yin, other things yang. That's what we call about diversification. Energy has been a great hedge. And if you look at it over the last couple of years, it's probably been one of the better performers next to technology that you want to own in your portfolio.
Yeah, it's like, what sometimes when there's the elephant in the room that everybody's talking about, right, as opposed to ignoring. You have so many other great themes going on, right? The world's going to deglobalize, right? We've had a lot of nationalistic movements around the world. You're starting to see onshoring, nearshoring, whatever you want to call it. You're going to have this huge infrastructure built in our country. There's so many opportunities, so many companies' earnings are projected to be records that, sometimes when you think about the Mag 7, you got to ask yourself, are there really only 7 companies in the world that are going to grow? I mean, the rest of the world is just taking off. They're just not going to, get a return.
The short answer is yes, Bob. That's it. There's nothing. Don't look beyond the curtain.
And thank God Ryan told us to buy those stocks 3 years ago.
Well, no, it's a great point because you start looking at the earnings projections, right? Almost every sector is going to see earnings growth this year besides materials and energy because prices have come down from where they were. But you go into next year, literally every sector is going to have close to double-digit returns, based on what the earnings projections are today. So earnings are going to start to accelerate or reaccelerate for a lot of parts of the economy or a lot of sectors of the economy. And as we know, there's lots of parts of the market that trade very, very cheaply, and they pay a lot of cash flow, which as diversifiers like we are, we're like kids in a candy store right now.
Well, guys, I talked about it in my market commentary last week. Wealth creation isn't about investing in what's popular. Like when the person came in to install my screens the other day, they wanted to know if their purchase of call options on Nvidia was a great idea. Like when you have people who are not involved in investing are suddenly investing in the hottest stock in the market, it's not a good trend. Wealth creation is about accumulating the most shares of an investment before it becomes popular. Like you said, Rye, oil was unpopular for a while, right? Everybody knew the Biden administration was going to put the oil industry out of business. What happened? We're drilling more oil than ever in the history of the planet, of the country. And secondly, those stocks are paying great dividends. And meanwhile, like you said, it's the second hottest sector in the market this year. Nobody predicted that.
It's funny. I met with a client of mine a few weeks ago, and for years and years and years, they hated their pipelines. Like, oh, we got to sell these. Let's get out of them. We hate our pipelines. We hate our commodities. And now they're like, oh man, this is the best thing sliced bread. We should have bought more of it when we had the chance. And it's really amazing how things change. Yeah.
Yeah, things do change. And I think that's when we saw that back when the market sold off 2 years ago, is commodities were a great hedge in your portfolio. And again, even this year, when you have a bad day in some of the more popular stocks, you have less popular places like energy and commodities that have gone up. So it's a nice counterbalance in your portfolio. And those trends are going to continue to change. And that's why you have to be there, to Bob's point, ahead of time. You got to have money in all different places ahead of time, because people are always asking me, like, when's the Fed going to cut interest rates? When's inflation going to come back to the 2% target? I have no idea, but I want to have money in places that are going to benefit when it does happen, like places like small cap stocks, which have done nothing, which eventually will probably do really, really well if the Fed cuts interest rates. You got to be prepared ahead of time.
Yeah, I think it's a foregone conclusion that the Fed will start to cut rates, just a matter of when, right? Could it be in the September meeting? Will it be after the election? Will not be any at all in 2024? But clearly, the bond market, right, the bond gods, as I call them, are signaling that rates are going to drop, because you look at the 10-year, you look at the 20-year, you look at the 5-year, those yields have been coming down for the last couple of weeks, even though you still can get 5.3% in a 3-month treasury. I tell you what, that's not going to be there for I don't think much longer.
Well, you know what, Dad? Actually, I'm really disappointed to find out that Ryan doesn't know when the Fed's going to cut rates. That's why I joined the podcast today. But yeah, that's a great point. I mean, it's like you want to grab those rates now while they're still high, because, there's a good chance that they will go down.
Well, you're also getting a normalization of the yield curve, right? Usually long-term rates are higher than short-term rates, which hasn't been the case for a while here. But again, if the Fed does cut, and meanwhile, we're seeing energy prices go up, we're seeing some more inflationary pressure because of oil prices, you're seeing the longer-term bond rates start to go up. So you're getting that normalization again. And I think it's fair to say eventually things will probably get back to normal. I don't know the magic day when it's going to happen, but again, you got to prepare for it. You got to build your portfolio to prepare for those scenarios.
Well, I actually think we are at normal, right? When you look at what the Federal Reserve's done, I think they brought the bond market back to normal. I kind of believe that the 10-year yield is going to fluctuate between 4 and 5%. So if you can give me between 4 and 5% on my bond portfolio for the rest of my life, I'm a happy camper. And so it's like you got to be careful about what you wish for. I like having yields that are consistent. I like being able to roll over money into even a higher yield when it comes due, because at the end of the day, I need that income, for me to go into retirement.
So I guess now we got to change your nickname from Bobby Bitcoin to Bobby Bonds.
Well, it's another good point too, is, we're probably not going to see really low yields again, like we said last decade, because the reality of it is economic growth is probably going to be pretty good, right? We're seeing that right now. Consumers are still spending. Maybe they're not happy about spending, but that's not stopping them from spending. If you look at just the amount of people that are going to go through a TSA line over this 4th of July weekend, it's going to be a record. People are traveling in droves. And as far as we can see, inflation is moderating in the short term, right? Shelter costs will continue to come down. They're kind of stubborn. And this labor market's still going to stay relatively tight. It's just because of demographics, because of the amount of job openings that are still available out there. That's probably going to still put pressure on keeping wages higher. That's a pretty good combination. And that's a combination that probably equals more consumer spending this year, more economic growth, even if people are feeling the pain, no pun intended.
Well, I think that's what happens, right? You see, everybody's focused on the Fed cutting interest rates. Well, since the Fed started raising interest rates, the stock market's been rallying, right? So we hit an all-time record high last week on the S&P for one index and the Nasdaq, while rates have not been coming down, guys. So a lot of times it's so simple to think about cause and effect when it comes to investing. It doesn't always align. Matter of fact, it rarely repeats. So, you got to get that out of your head and just think about, what is it, what isn't happening, right? What isn't popular? What isn't the conventional wisdom, right? The market always does what it needs to do to frustrate the majority opinion of the day. So when you're at a cocktail party, when you're out in a country club, when you're talking to your buddies and friends, whatever they believe and you all agree, do the opposite.
Hey, hope you're enjoying episode 153, Pain Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you saved over $1 million for your financial independence plan and you want a more hands-on approach, Bob, Chris, and I now have a collective 75 years helping individuals just like you with your planning and investing. This is what we do every single day. We'll put together for you a total financial master plan. We'll do a bird's eye view of your entire financial life and hone in on every financial issue you need to address today. There's not a firm out there that will do this work up front. In fact, we'll build you your own personalized financial portal. We'll go through and look at everything you need, from an income plan for retirement. How do you draw from your portfolio? How do you take Social Security? We'll do a full deep dive of your total portfolio, look at your diversification. Have you had way too much money in the market? Have you seen your portfolio go up and down like a yo-yo? Or have you been sitting in cash, paralysis by analysis, can't figure out what to do? We'll put together a full investment game plan. We'll show you how to grow your wealth, tied to your goals, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, insurance product, structured product, brokerage product. We'll do a deep dive of all those investments, show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook. If you saved over $1 million for your financial independence plan, simply go to www.payncm.com/financial plan or click on the link below to see if you qualify for a free financial review. All right, it's the tipping point. This is where we pinpoint the pain point. Of course, that's Payne, having the biggest impact on your wealth right now. And guys, contrary to popular belief, I know it seems like you just pick the right stocks in a bull market. They go up like thousands of percent, and then you're set for retirement. And that's all you need to do. But we know in reality, that's not really the way to build wealth. It's not the way to create that secure financial independence plan. And I mean, after our 75 years, it's really just those small tweaks that you make along the way that really builds wealth. And most of us don't actually take the time to do those small tweaks. So I thought we could talk about those smaller changes you can make to your portfolio on an ongoing basis that have a huge impact later, as opposed to just hoping for the best and picking hot stock.
Sounds like to me, Rye, you have it sounds like when you go to the casino, right? You have a strategy for how am I going to lose money tonight? You got a 2-hour, 3-hour strategy on how you're going to gamble. And a lot of people approach the market that way. Financial planning is about achieving your goals and doing these little things, and investing is just one small part of it. But you've got to have a long-term strategy in your investing. You can't just, I'm going to throw some money at a couple of hot stocks.
That's a really good point, Dad. And, Ryan and I recently met with a client of ours, and we looked at his whole portfolio. And of course, just like everybody else, he's very excited about owning Nvidia and the Magnificent Seven. And we actually were able to show him with Social Security and his portfolio that basically he has enough income to live off of without taking too much risk.
You know what it reminds me of, guys? It's like those ads that say like, get ripped in like a week. You'll see somebody who's like overweight, and then a week later, they're just like, they have these strong muscles and they just turned it around. And I think that's exactly what it's like today. It's like buying the next AI stocks that are going to go up overnight. Whereas, as we know, getting in shape, doing anything that's worthwhile, it's long, it's boring, it's about consistency. And the first thing I think about, Aaron, I know you and I worked on a couple cases lately too, is just optimizing for taxes. It has a huge impact, but we don't take time to do it because it's boring and it takes a long time to really, have a huge effect on your financial life.
Yeah, right. It's really amazing to see what impact something simple can have, like doing backdoor Roth contributions each year, or looking at doing Roth conversions between retirement and your age for required minimum distributions. And I feel like when you're on this ride with these AI stocks or something that's really having a big move up, it's so scary. You don't want to get off the ride because it's, you're getting such a high, and now you have all these unrealized capital gains. You don't want to get hit with the taxes. It's going to be a much uglier scene if you ride that up like the dot-com bubble, and now all of a sudden, the stock loses half of its value in the blink of an eye.
Hey guys, I'm all up. I'm all for stocks running up big time. I mean, I look at our large cap growth portfolio. We started paying capital in 2009, right at the end of 2008. That portfolio is up 1,000%. So capital gains for any prudent investor are inevitable, right? You're going to have to you have to pay taxes on it. That's why doing these little things like you talk about, booking losses when you have a loss. You see a loss, take a loss, put it in the loss bank. I guarantee you'll be able to use it and pay less taxes.
Yeah, no, and less taxes are good, Bob. Last time I looked. And that's the whole thing. It's like when you start looking at it, we always say this, but it's not what you make, it's what you take. There's so many little things like owning tax-free bonds versus taxable bonds. Well, if you're in a high tax bracket in New York, that's like getting 6% on your money on a pre-tax basis by just tweaking how you're earning your income. Also, your accounts are taking tax bombs. Your retirement accounts, you have to start taking those mandatory with distributions by the time you're like 73. You can be proactive, start converting some of that money to tax-free earlier.
Well, the other benefit too, Ryan, that's a really good point, is the fact that taxes right now are probably lower than they'll ever be. So good chance taxes will go up in the future. By doing those conversions now, you have to take less distributions when you hit that 73 or 75 age, which means you'll pay less taxes on that
Chris,
money.
you don't remember this, but Ryan grew up wanting to be a farmer. And, when you have a farm, it's all about yield, right? What does that crop yield, right? What are you going to get in terms of what you grow? And, your financial plan is not a portfolio. Your financial plan is doing all those little things, planting, the right things that will give you the yield you need to sustain you through retirement. So, if you don't do those little things every year, you miss out. And that compounding effect is really the difference between success and failure.
Yeah. And the other I don't want to say easy, but the other simple thing that you can apply to your portfolio is, and Aaron, you and I worked on a case recently. We showed a client just how much income they can compound and generate no matter if the market goes up or down, right? We were so focused on capital appreciation, but the real magic to investing is generating current income you can either use or you can reinvest back over your portfolio.
Yeah, and it's so dependable year over year, regardless, the market's going up, down, or sideways, you're getting those interest payments, you're getting those dividends. Oftentimes they're taxed more favorably, with qualified dividends. And that compounding over time, that's the real magic. You look at that over a 20-year time period, you could be in a situation where half of the growth in your portfolio is from income.
I was looking at the returns this year so far, and large cap growth has obviously blown the doors off, as it has for a year or so. But, you look at things like large value, blue chip dividend paying stocks are up close to 9%. That's an 18% annualized return. I'll take that any day of the week. But meanwhile, you've got the dividends, which are going to return 40%, almost 50% of your return in your portfolio in your lifetime. You can't discount that.
No, you can't. When you think about income, is when you're retired, inflation is going to mean you're going to need more income, right? I mean, over the life of your retirement, your income needs could double. I just went back 12 years ago, and $1 million portfolio that was paying $40,000 pays $55,000 today in income because the income went up 37%. And you have to ask yourself, when you get to retirement, is the income on my portfolio increasing because my income needs are going to increase over time? And this is something most of us don't solve for.
So wait, Ryan, are you saying that we probably shouldn't have our portfolio 100% in Nvidia or cryptocurrency?
Well, see, Chris, if you'd have done that, then you could sell it all and then buy this boring diversified portfolio where you're set for life. So, it's all about timing, buddy.
Chris, my timing would be a lot better if my crystal ball was still working. But sadly, it just doesn't work. The other thing is a question came in actually from one of our listeners. And I thought I wanted to repeat the question on the show because it's also about where you place your assets in your portfolio is critical as well. And, the listener wrote in, I maxed out my Roth IRA for the year. I put some money into my pipeline energy exchange traded fund with my taxable account, which is not a bad idea because the income on that's tax advantaged. I'd like to put some money into emerging markets, exchange traded funds, and real estate investment trust, exchange traded funds in my taxable account also. Is this a good idea from a tax efficient standpoint with these dividends? Or should I wait until next year and invest these dividend exchange traded funds in my Roth IRA? Well, that's a great question because, where the income you're generating and what kind of income you're generating definitely constitutes what account those assets should go with.
That makes a lot of sense, right? I mean, I've always had the strategy because you work with high net worth individuals with high income so they're the highest marginal tax bracket, always put the municipal bonds in their taxable account. Because number one, it's going to generate tax-free income, so it's going to minimize taxes. But you're also going to have more liquidity, right? You have a safe investment where you can get money in the case of an emergency. You want your longer duration assets, right? Is what we call equities or 30-year bonds. You put those in your retirement accounts because theoretically and practically you're going to have capital gains and you're going to have your best returns. So you want that sheltered as long as possible.
Also, to this listener's point, well, if you have master limited partnerships or real estate investment trusts, they tend to be tax advantaged. The income on those, you don't want them in your Roth because your Roth, you're already getting it tax free. So I would say you want your tax disadvantaged assets would do better in there because you're never going to pay taxes on that money. So these are things you do want to think about. To your point, put your high growth, tax inefficient assets in the most tax efficient accounts. Say that twice fast.
So, Chris, are you still a big believer in income? I mean, you tell me about it every week, so I just want to check.
My favorite saying is you get a better outcome with income. And yeah, Dad, I'm a huge fan of income. As a matter of fact, whenever I meet with my clients, I always show them what their portfolio generates. And I ask them how many years of working it took them to reach that point and how hard they had to work to get that. And they're always blown away because it comes in no matter what, without any work.
Because your brother, he works me like a dog and pays me like a puppy. Because of my lack of W-2 income, I got to depend on my portfolio for income. So thanks for the advice.
When it comes to maximizing your wealth, cash flow is king. Generating a steady stream of income is one of the most critical factors to maintaining your financial health well past your working years. That's why my firm, Payne Capital Management, put together our latest guide. We give you 5 smart income strategies for your $1 million plus portfolio. We give you 5 ways to generate income to help you on your path to financial independence. You can download it for free. Simply text your email address to 844-752-6692. That's text your email address to 844-752-6692. And you can download our guide completely free. 5 smart income strategies for your $1 million plus retirement portfolio. Download it for free today. All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, U.S. imports from Mexico have jumped sharply to $484 billion from $322 billion in February of 2021, while U.S. imports from China are flat over the same period. Looks like we're doing a lot more nearshoring to our friends in Mexico.
Yeah, it really is, right? The reshoring, nearshoring, whatever you want to call it, it's absolutely happening. Everybody, not everybody, but everybody I speak with is pulling, out of China and moving to Mexico or even here, or Thailand or Vietnam, anywhere but China, it seems. So it's a trend that I call it the COVID effect, where we found out that our supply chain was in trouble, was in jeopardy, I think caused this inflation. And we're going to start seeing a lot more of this going forward.
Yeah, I agree with you. And this manufacturing boom, it's real here in the U.S. It's pretty remarkable the amount of money is being spent on infrastructure here. Chris, a record 48 million Americans aged 65 and up are not in the labor force as of May. Birth rates, 3.64 million in the past 12 months, is barely keeping pace with deaths of 3.15 million people. This labor shortage is probably not going away anytime soon.
Yeah, the other thing too, Rye, is I think Dad's expecting more grandchildren. So why don't you get on that?
All right, I'll be back in a couple of months. I'm going to work. Bob, the number of U.S. air travelers hit a record Sunday with 2.99 million folks flying. That record could be broken as soon as Friday, when more than 3 million travelers are expected to fly before the 4th of July holiday. People are spending money on travel. They aren't staying home.
Yeah, I love it, Rye. I see a headline once a week. Consumers tapped out, right? There's defaults on credit cards. Well, guess what? The consumer's spending just as much as they were before. They just shifted from home improvements to now they're just flying and floating, right? They're traveling like crazy. Airlines are booked. Cruises are booked. I mean, everybody's on a cruise. So it's just a matter of they're shifting their priority, but don't ever discount the American consumer's desire and ability to spend.
Amen. The sun rises in the east. Americans will spend money. It's one of the great truths of life. Great show. Happy 4th. If you enjoyed our podcast today, episode 166, please subscribe to our channel on Spotify. If it's on Apple, you can also subscribe. Give us that 5-star rating. Your support gives us the support to continue to do this podcast. And if this is on YouTube right now, you can like this episode, subscribe to the channel, click that notification bell to be updated every week of all our new content. That's it for this week. Stay loose and keep an open mind.
Thanks for listening to the Pain Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Pain Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.